Good afternoon. Thank you all very much for joining. Welcome to Netwealth's latest webinar, this time titled After the Election. Thank you for joining today on this sunny afternoon, a rare one for this summer, down in London at least. Today I'm joined by Dr. Gerard Lyons, our Chief Economic Strategist here at Netwealth, and I'm Tom Kimchi, the Head of Advice at Netwealth. And today we're going to be talking about the election, of course. It's an interesting time in the UK, across the world. Lots going on. We will be focusing particularly on the UK today, but we'll also be talking about what it means as a UK-based investor investing globally, and how what we've seen during the election, after the election, and across the world to an extent, how that's meant that you might want to make changes to your financial plan. So we're going to be looking at the political landscape, we're going to be looking at economic and policy implications, and we're also going to be providing some practical suggestions, as well, of course, as answering questions that you send in along the way, and answering, of course, some that you've very kindly sent in advance. So we'll try to keep it interactive. We'll answer some about halfway through, some towards the end, and you can use the chat functionality, or sorry, it's actually the questions functionality on your GoToWebinar software to send in questions as they come up. You'll see at the bottom of your screen, we have an email address there, advice@netwealth.com. If you had any more personal questions, feel free to send those directly to that email address, but otherwise we'll be very happy to answer what we can during this webinar. Finally, for the introduction, there will be a link put into the chat. So if you click on that, you'll be able to actually be able to book a call directly in with one of the advice team here at Netwealth. So you can have a session to discuss any of your questions, any personal planning considerations, or anything else about Netwealth. So certainly feel free to book a complimentary call using that link, and we'll also send it via email if you're not able to look at that now. But first, I'm going to hand over to Dr. Gerard Lyons, who's going to start by thinking about the economic picture following the election.
Well, thank you, Tom. Hello to everyone. Thanks for making time available to join us. In the next 15 minutes, I'm going to focus on three areas: the current economic picture, second, the government's policies, and third, the whole fiscal stance, which is a key aspect of their whole economic agenda. But let's take the economic picture. If we go on to the next slide, the good news as we look at the economic outlook is that the economy is improving. Economic growth in the last 3 months to May was up by 0.9%, which is an annualized rate of 3.6%, which is very strong by UK standards and indeed by Western European standards. More particularly, the immediate outlook looks good over the next 18 months. Growth has some momentum. When one looks at the outlook for any economy, it depends on the interaction between the economic fundamentals, policy, and confidence. Of those factors, the most difficult to predict is confidence, but certainly there's no doubt that the fundamentals suggest that the economy will improve further. And in the last few days, the International Monetary Fund itself was quite upbeat, I would argue, about the UK. Of course, if the economy loses momentum, there is the scope for interest rates to fall. And indeed, I do expect, because of low inflation, rates to fall anyway, but I'll come to that later. There are two big buts. Normally, people think stronger economic growth, that means the fiscal stance is going to have a lot more room for maneuver. And that is correct. But it's important to stress that an economic recovery has already been factored in to the government's fiscal plans. And as I highlight there, at the time of the March budget, the independent forecaster, the OBR, then was predicting relatively strong growth for this year of 0.8%, 1.9% for next year, and 2% for the year after. Just in contrast, back in March, the Bank of England, which was pretty pessimistic, was probably more indicative of the wider consensus. So you can take on board the fact that even though the economy is picking up, that's already been factored into the fiscal plans the government's inheriting. I do actually think growth this year will be nearer 1.1%, 1.2%, so there will be some room for fiscal maneuver. The other point, though, to stress is that globally, some of the recent economic data has been soft. And if we go on to the next slide, I'll point this out in more detail. Right, there's two things here. First, the vertical axis, and the second is the horizontal axis. And hence we have a 4-sector graph. It's not as confusing as it might appear. Let's take the vertical axis. This is a graph of economic data relative to expectations. It's used widely in the financial markets to get a gauge of whether an economy is on the up or potentially on the down. So on the vertical axis, you have 0, Anything above zero means the economic data is coming in better than the markets expected. Anything below zero means the economic data is coming in worse than the market expects. So it's relative to expectation. Then go along the horizontal axis, and to the right of zero means in the last 3 months, that economic data is improving relative to expectations. And on the left, it's actually in the last 3 months getting worse. So if in the bottom left-hand segment, which is where many countries are, you can see the recent data has been worse than expected. And in the case of the US, the trend is poor. That's why interest rate cuts are now on the cards in America and indeed have happened in the Eurozone. But the reason for showing this graph is in the top right. Recent economic data in Britain has come in far better than the markets expected, and the trend has improved. If only Rishi Sunak had known that before he had called the election, who knows? But the backdrop is pretty good. Then we move on to the next slide about inflation. Inflation is now down at 2%, back to target. It's going to boost, therefore, real incomes because wages are growing more than inflation. But again, there's a but. Core inflation is 3.5%. That's when you take out food, alcohol, tobacco. Service sector inflation is stubbornly high at 5.7%. So even though 2% inflation means that the Bank of England should be thinking about cutting rates, because of core and service sector inflation, they're a bit reluctant to do so. It means there probably won't be a rate cut in August, but I think by September there will be a cut. The Europeans will be cutting for the second time by then. The Americans might well be cutting in September as well. And I think interest rates, which are currently 5.25%, which will trend down in Britain to 4.5% by the second quarter of next year. But the point is, inflation's trending down. That's good, but there's some stubbornness. But bear in mind the figure at the bottom of the page. Partly because the Bank of England didn't do a particularly good job, and partly because of supply side shocks a few years ago, the level of prices is 22.6% above 3 years ago. So inflation is down, but many people are still feeling the pinch in the cost of living crisis. If we go on to the next slide, this basically puts this in graphic form. Inflation trending down, headline rate the lower figure, but core and service sector inflation slightly stubbornly high. Inflation will actually trend down further in coming months, helping the Bank of England cut rates. Where headline inflation settles might well be above 2% as we move into next year because of that stubbornness of service sector inflation. Enough to make the Bank of England cautious, but not enough to make the Bank of England not cut rates. But it does mean that interest rates will likely settle at a much higher level, around 4.5%, say, maybe even 4 to 4.5%. They will settle at a much higher level than before the pandemic. Let's go on to the next slide. And this highlights the backdrop, though. Despite this improving economy, there are issues. And this is at the heart of what Labour is thinking about and where economists tend to focus their attention. We're an imbalanced economy. That's not just London versus the rest, that's urban, rural, coastal, inland, homeowners versus renters, skilled versus unskilled, and also older versus younger people. So imbalances. We are a low growth, low investment, low productivity economy. And the key issue is that the economy has not really recovered strongly since the 2008 global financial crisis. In years, as opposed to trend rates of growth, before 2008, in years, it took the economy maybe 26 years to double in size in real terms, take out inflation. Now it takes the economy closer to 60 years. So much lower trend rates of growth do impact living standards. And the challenge, of course, as we well know, in the last 15 years, expectations have not really adjusted, so we don't cut our cloth accordingly. Also, as I'll come to in a second, debt levels are high, we have a high tax take, and even though public spending is very high, as we're hearing from the new government, they think too many areas are squeezed in terms of spending. And of course, the issue that's not really talked about enough in the UK is that the population is rising rapidly and is set to rise even further. So GDP per capita is still falling, even though the economy is actually growing more strongly. That's the backdrop. Let's move on to the second part of my talk, which is about government policies. If we go on to the next slide and go straight into economic policy. This is the key issue. This is this is overall investment as a ratio of GDP. Now, some people will say it's about 2016 and the Brexit referendum. Some, like myself, highlight 2008. But let's go back to that graph, and it shows investment relative to GDP since 1970. Back in 1991, I hate to say, I wrote a big piece in the Times saying that British investment was too low relative to the G7. I now hear that being said by lots of Labour Party advisors. So I agree with that. The thing I've learned to take more on board in the last 30 odd years is that while low investment in itself is an issue, you need to think about the rate of return on capital and the rate of return on investment. It's not simply a case of saying higher investment guarantees higher growth. It's also about saying, do we have the right type of investment? And basically, you need to incentivize the private sector to be investing. But at the heart of Labour's thinking is this argument that we need to get investment up. And if you do that, hey presto, everything will start moving into place. Some of that is true, but not all of that is true. And let's move on to the next slide and go through the King's speech yesterday and some other aspects of policy in more detail. Look, I'm not going to dwell too much because you've undoubtedly seen this on the television or on social media last night and in the papers this morning. But let me highlight what I think are the key issues you should take away. A huge amount of legislation. This will take time, and full details of the legislation has yet to emerge. Basically, government policy has yet to be formalized in the legal way. If the bill is straightforward, it still needs to go through 12 steps to become law. When it's more complicated, there's a lot more checks and balances. And if the government uses statutory instruments, secondary legislation, they will run into the courts and problems there as the current government has. That's why it's very important for this government to make any changes to planning and housing primary legislation. But in doing that, that in itself is likely to take a lot of time, both in the Commons and the Lords. There are 40 bills. Normally in a year, you have 20 to 24 bills, as I understand it. So a lot of legislation, some of it, of course, is hanging over from the previous government that will likely go through quickly, no smoking bans, but it's going to take time. That being said, the government is trying to hit the ground running, and economics is center stage. 15 of the 40 bills are linked to the economy. The third point on that page is the focus is on fiscal policy and the supply side. When you think of economic policy, there's really three parts to a pyramid or to the triangle. One part is monetary and financial policy. They're not really focusing on that. They're focusing on fiscal policy and another part of the pyramid, supply side. On fiscal policy, I'll come to in a lot more detail in a moment, is about more technocratic regulatory involvement behind the scenes, and the supply side agenda covers a host of areas. There is significant institutional change. This is basically not just quangos as Prime Minister Blair introduced and others have introduced, but these are actually also statutory bodies, a new wealth fund. There's going to be a Great British Energy Group. There's also other things such as an Industrial State Council and other things behind the scenes. And overall, this is about greater role for Westminster, Whitehall, and also devolution. In terms of Westminster, that's number 10. Whitehall, it's regulators as well as the Whitehall machine. And also there's greater devolution to metro mayors. So the state is becoming more important, more powerful, which in itself poses a challenge. If we go into the next slide, I'll explain what I mean. When leveling, sorry, also in terms of this aspect, the new fiscal lock is basically very key. This is about fiscal responsibility. Then these are the other key issues, housing and planning. This for most economists is the most important area that will deliver economic growth. But as I've touched on, it will take time to be executed. There are a number of different aspects, the green agenda and net zero. Now, I'm fully supportive of the move to the green agenda, but the important point is to do it in a way in which you need to recognize that the economy still runs on fossil fuels, even though renewables are becoming quite rightly more important. Some critics say that we could have brownouts and blackouts in the next few years, which is a worry for the economy. So the evolution is right, but if we do it too quickly, too soon, there could be problems. Focus on public investment and very much the creation of a wealth fund. And then on the downside for many economists is the impact of the Employment Rights Bill. How will this impact one part of the economy that really works well, which is the flexible labour market? And then finally at the bottom is closer relationship with the EU. Now, let's not go into Brexit, but Brexit was a political event. You could say that's been and gone. But in economic and financial terms and other parts of the economy, it's about the process. Clearly, there's an argument for greater relationship with Europe in terms of defence, etc. But importantly, in economic terms, we will not be rejoining the single market or customs union. And often overlooked is that the Labour government, particularly if it wants the state to play a bigger role, has more room for manoeuvre doing that outside of the EU's power, shall we say. And on to the next slide. In the last few years, there was a lot of talk about levelling up industrial policy without using the word industrial policy. Labour's more explicit. Industrial policy takes centre stage. But I use this word, the acronym FEED, as covering the 4 bits that you need to get right to make this work. And my point would be that yesterday, 2 of the 4 have not really been covered. Finance. You need to have lending to small and medium-sized firms. That is still a problem. Empower. You need to have the private sector playing a big role. And many in the private sector will be worried about taxes, regulation, and greater intrusion. What the government, though, has focused on is the other 2 letters, enabling through devolution and diffusion. Their argument is that the state and devolution will allow those productivity gains to be spread. That concludes the second part, but let's go on to the third part, the next slide, and move on to fiscal policy. Look, it's good that the government is putting growth at the centre of the agenda. We have a situation where debt levels are very high, close to 100%. You're in a debt trap if your level of debt goes above 100% and if your rate of economic growth is less than the rate of interest you're paying on your debt. 6 of the G7 countries, Germany is the exception, the G7 are the 7 industrialized economies in the West. 6 of the G7 countries face a challenge with debt. Britain is one of them. Now, in the next year and a half, debt to GDP ratios will improve as the economy bounces. Beyond that is the real challenge. And this is what you really have as your options. Grow the economy, reform, such as reform your big area of spending, the NHS. Austerity by controlling spending, taxes, borrow. Or some people say inflate the debt away. But let's take the 5 big issues. The government is focusing on growth. That's the right thing to do. Reform is the other area. Let's see how they get on. Austerity, I don't think we're going to really see much curbing of government spending. Taxation, tax take is already very high, but if spending goes up and if growth disappoints, taxes will go higher. And borrowing, yes, there's already ample government borrowing and the room for manoeuvre there is limited. Let's go on to the next slide and delve a little bit more into the detail. We have a statement by the Chancellor, Rachel Reeves, before the end of July. She's going to say they're inheriting a situation that's far worse than imagined. It's unfair for her to say that because everything is open and transparent. She'll then say that relative to the OECD countries, we're growing at a lower pace. Notice the switch from G7 to OECD. OECD includes the likes of South Korea, etc. Many countries outside Western Europe grow at a far faster pace. We will have a budget and a spending review in the autumn. Labour is planning a new fiscal lock. This is very much about empowering the OBR, the independent authority. The challenge here is that the way the current system works is back to front. The OBR, in my view, does have credibility and is very competent. But because of the fiscal rules, The forecasts of the OBR set policy rather than things working the other way around. And on Monday of this week, I joined a meeting which is the start of the 5-year external review of the OBR. So there was a half a dozen of us there, people from the Institute of Fiscal Studies, Resolution Foundation, Citibank, Institute for Government, National Institute, myself. And my point was very much, we need to make sure the process works. And the challenge many economists have at the moment is that Labour's approach might actually move us from the OBR commenting too much and not addressing problems with the current fiscal rules. Notwithstanding that, the issues at the bottom are very much the problem. Spending is already high, tax take is already high, therefore growth has to deliver. And if it doesn't, we're in a difficult situation. Let's go on to the next slide, just one more minute. And this is government spending and where they get their receipts. Government spending is 1.1 trillion, just under 1.2 trillion. You can see where the bulk of their income comes from, their receipts. Income tax, top right, national insurance, bottom right, VAT, middle left. The big three taxes are income, national insurance, and VAT. You can see the others are quite small. Let's go on to the next slide. And this is the issue. In its election manifesto, the government committed to a triple lock on income tax, national insurance, and VAT rates. The current plans, though, do mean that allowances are not indexed, so people will be brought into higher income tax bands. There's a new spending round that's likely to see some of the non-ring-fenced government areas, maybe prisons, local authorities, etc., get more money. And therefore, you need to square that circle. Stronger economic growth this year will give a bit more fiscal space. But the issue then are the issues at the bottom. Where do you get more revenue from? Property tax, revising council tax bands from their current 1991 level, so basically a higher tax through property. Capital gains tax probably being aligned with income tax. Fuel duty quite probably being reintroduced to go up. Then there are other issues such as pensions and other reliefs may be being changed. Inheritance tax changes, maybe not immediately, but eventually. And the other two, not now, but parked for the future if growth doesn't deliver. To conclude, if we go on to the final slide, this is interest rates. Interest rates are 5.25%. Interest rates will come down to 4.5%, as I touched on. And then final slide in terms of conclusions, where do we go from here? Look, the government is inheriting an economy as it's improving. That's a positive, but it is a low growth, low income, low productivity economy. For the government, it's very much about economic growth and public investment. That makes sense, but public investment by itself, while it's positive, we need to see the private sector empowered. And then it's about rate of return that's linked to capital gains tax, maybe corporation tax in particular, linked to interest rates and ability to raise finance. It's also about small firms like to have simple, stable, predictable taxes, and they want to see low, light regulation. So it's about squaring the circle, but there's no doubt that the economy looks set to improve over the next year or so, but we face a real issue. Either you deliver on the growth or the plans point to higher government spending leading to higher taxation. Thanks for your time.
Excellent. Thank you very much indeed, Gerard. That's really, really helpful indeed. Before I move on to my section, I thought it'd be helpful to answer a few questions quickly. So I can see that two people have raised their hands, so to speak, using the software. We can't go to you directly, but if you do have a question, feel free to type into the questions box on the sides. One that's come in during the webinar, Jerry, relating to one of your earlier slides, was why is the UK economy performing better than the rest?
Why is it performing better than the rest? Well, I think it's important to say, step back structurally, there is a big shift in the balance of global economic power to the Indo-Pacific, which is from India in the west to America in the east. And so we need to think about global growth very differently. The slow growth region of the world economy has been Western Europe, including the UK. The UK has outperformed Germany and Italy in the last few years, pretty much on the par with France. Why is it improving, performing better? It's partly because we were hit hard, and it's partly maybe because we're starting to see inflation come down and real incomes picking up. So it is bouncing. So it's a combination of factors contributing to that. I hope that answers.
Excellent, thank you. Another one we have here, I've actually had quite a few questions, as you might imagine, on capital gains tax. So we had a question here on how will the government square business growth with increasing capital gains tax? And then also, where are we on the Laffer curve with capital gains tax? Will it raise any money? So for those not aware, the Laffer curve is it looks at the relationship between tax revenue and tax rate, and the theory goes that if you increase the tax rate too high, then that can mean actually you raise less revenue. So over to you, Jared.
Yeah, well, obviously we have up-to-date data on capital gains tax, but there's an annual review that delves into the detail. And the latest annual review that came out is for 2021 to 2022. So capital gains tax, it raises 16.7 billion pound. It's paid by just under 400,000 people. In terms of the link to business, a part of capital gains tax was called entrepreneurs relief. That was abolished by the Conservative government in 2020, and it was renamed the business asset disposal relief, and it was reduced in size. So in the latest breakdown of data for 21-22, 7%, I think it was, of capital gains came from that previous entrepreneurs relief. It was paid, and that was paid by about 50,000 people. So the argument is that if you raise capital gains tax, it is a deterrent to business and it sends the wrong incentive, wrong signaling. But some of the damage has already been done in 2020. In terms of the Laffer curve, I'm not always a great believer in the Laffer curve, even though there are times when it does work, often because a Laffer curve is then used to justify trickle-down economics, which is not where I'm coming from. But in terms of the aspect of it, we have a very progressive tax system in the UK, and we should not forget that. The top 1% of income taxpayers pay 31% of income tax. When it comes to capital gains, the top 1% of those who pay capital gains pay 45% of the capital gains. So it's already very progressive. And also often overlooked is that you have a large number of people, about 2 out of 5 people who pay capital gains tax have capital gains of less than £50,000 and taxable income of less than 37,800 people. So it's not just being paid by lots of rich people. Maybe it's paid by people who manage their affairs. They pay a certain amount 1 year, etc. But so it is linked to that Laffer curve debate, but in an indirect way. And the point really is it's a pretty progressive tax as it currently stands.
Great, thank you. And time for one more, I think now, and a slightly different track here, but how can Labour improve GDP, sorry, per capita, especially in northern cities?
Okay, in terms of
Particularly
northern,
affecting productivity, I think.
yeah, that northern cities point is really that FEED acronym I talked about, which I think is important for levelling up. Levelling up, it's about finance to small and medium-sized firms. It's about empowering the private sector. It's not only about empowering local authorities, it's enterprise needs to play a role. So finance, enterprise, empowering states, and then about that diffusion aspect. Often the diffusion is that we often talk about the gap in productivity between London and the rest. But often when you get to, say, the Northwest, the gap in productivity between the highest performing companies and the lowest performing companies is actually a greater gap within the region than it is between the top performing companies in that region and London. So you need to spread the gains of productivity across. And there's a whole host of ways of doing that. We need to incentivize private firms to invest, to do things, and therefore you need to ease the burden on them in some respects. So productivity growth is the key because higher productivity growth delivers higher wages, higher standards of living, and higher sustainable growth. On the population aspect, unfortunately in the UK, population is not talked about as centrally in the economic debate as it should be because it naturally gets linked to immigration and people get very uncomfortable talking about immigration because of the political connotations linked with it. But there's no doubt that population growth is rising. Therefore, we need to be looking at GDP per head. And even though we're building a lot more housing, we need to build more housing to make up for the gap in terms of the last few years and to keep up with the changing population in the future. So house building and planning is seen by economists as the most important positive part of the new Labour government. And indeed, in the Financial Times survey at the beginning of this year, each person who replied was asked to name one thing that they would do for policy to help growth. I said two things, basically easing planning reforms and institutional change. Half the economists replied said that planning reforms as well. So we're getting planning reforms once they're executed. It will take some time. That's a positive. We're seeing institutional change, but not the way I would like to see it. And in fact, it's probably going in the opposite direction and making things a bit more complicated. Thank you.
Great, thank you very much. I will now move on to my section. So, what does all of this mean for you? What practical steps can you take to help protect yourself from some of these changes or to take advantage of improving or the improving economic picture in general? So, as ever, we often talk about this, investing remains important. And that's really because for many people, inflation will still be there. As Gerard talked about, it has come down. It's not necessarily likely to come down much lower than it is now, but it's very likely that it will stay positive. And if you hold too much cash, then the real value of your capital will erode over time. We show that on this chart here by comparing the real value of cash once inflation is taken into account versus a balanced portfolio. We've used the Netwealth risk level 4 portfolio, a moderate or balanced level of risk there, with about 50% in equities. And we show the change in purchasing power over this period of time, so since 2007 to the end of 2023. The risk level 4 balanced portfolio has increased its purchasing power. Cash, of course, has lost lots of purchasing power, even though inflation was relatively muted over most of the years in question here. And one thing we get quite regularly at the moment in terms of questions into the advice team at Netwealth is, okay, but interest rates are much higher now, which is certainly a valid point. And of course, you can earn a higher level of return on cash if you can get about 5% by shopping around, which is more than inflation at around 2%. But the really important thing to consider there is the fact that interest rates are likely to come down. And what you miss out on potentially in a decreasing interest rate environment is very strong equity market performance or company shares doing very well. And that leads in quite nicely to the next point, which is if you're waiting for a market pullback, they happen a little bit less often than people tend to think. And it's notoriously difficult to call the top of the market or indeed the bottom and get in at exactly the right time. So we often talk about markets riding the wall of worry. So whether it's geopolitical risks, things like pandemics, concerns of the economy and various sectors being bubbles, often and almost always markets do trend upwards over time. And when we do get these interruptions, and of course you can see on this chart in front of you, lots of periods where markets do fall, often it returns stronger than ever, not long afterwards. And you can see on this chart here, going all the way back to 1997, the big falls you see are sort of a slightly more protracted one coming out of the dot-com bust, and then we have the global financial crisis in 2008, 2009. But then after that period, there was lots of concerns from, say, 2009 onwards, and lots of periods where lots of people thought, actually, the market now is quite overvalued. There's still lots of risks. And of course, there is risk. There are always risks, but you can see the significant strong performance since then. And we think that's not likely to be any different in the current period where we are now as well. So if you are sitting on cash, or if you have got various assets and you're not quite sure about the best way to structure them, we think something that we've created at Netwealth with the free pot theory is a good way of thinking about it. So it separates your asset base overall into three pots, and it's really ranked by liquidity and ease of access. So at pot one, you have your cash, your emergency fund, which everybody should have, of course. Pot two is your core multi-asset liquid low-cost pot. This might be your pension, it might be your ISAs. It's money that you might be putting aside for retirement, to pass on to your children, to pay for school fees, whatever it may be, but you want a return profile that is somewhat predictable. Yes, there'll be volatility because it's invested, but you have a good idea of the range of returns on the upside and the downside, and you don't pay too much for it, ideally. Moving on to pot three, that might be something slightly more esoteric, like your property, for example, because as much as property has done very, very well in the UK, it's quite illiquid, quite hard to sell at short notice. very difficult to sell in parts if you only need to realize some capital. But this could also be in pot three things like a friend's company that you've invested in, or single stocks that you're particularly interested in, or you find it fun to monitor the markets and express your ideas in that way. So these can be more volatile. It tends to be for the longer term. Sometimes you have a greater potential for high returns, but it usually means more risk as well. And the important thing really is to have the right blend, not having all of your assets in property subjecting you to the same types of risks and all being quite illiquid. And we think for most people, pot two is where you have the majority of your serious money, so to speak, the money that you want to earn sleep well returns on. You don't want to worry about too much, and you want it to grow ahead of inflation, which pot one is unlikely to do in the long run. So when thinking about investing, whether it's now after the election, where there are some positives, I think, in terms of a bit more stability with the government itself, lots of different planning rules and things like that being changed, that could be positive. But even in a more benign environment, or a sort of an environment where less is changing, then choosing your risk level is very, very important. And that'll often depend on your time horizon. So we show here three different net wealth portfolios. We have a very cautious one on the left-hand side in navy blue, a medium risk portfolio in grey, and a higher risk portfolio in blue. And we show the percentage of times in the last 25 years where you would have lost money over these time horizons considered. So 1 month, 6 months, 1 year, 5 years, and 10 years. And you can see that with 1 month periods, actually, there's a pretty meaningful chance that you'd have lost money, regardless of the risk level you chose. So it's over 30% each time. So that means really if you've only got 1 month, regardless of the economic environment, it's not really a good idea to invest your money in a portfolio that has volatility. If we jump to the end and you look at 10-year time horizons, you can see there are no 10-year periods in the last 25 years where you would have lost money with any of these portfolios. So that doesn't mean that you should automatically go for the high risk portfolio, but it says if you do have an attitude to risk that is willing to consider that, then it's likely to pan out well for you, and you're not likely to be in negative territory over that period. So moving on to the slightly more relevant things now following the election, let's look at some planning considerations, what might happen later this year. We've had lots and lots of questions on this, as you might imagine, and unfortunately, there isn't any very concrete detail on any of these things yet, and I've ranked the list of things here roughly in order of how likely they are, but it's very much based on speculation. So we've got VAT on private school fees. That was mentioned in the King's speech. That looks very, very likely. We're not sure exactly how that will happen and what exemptions there might be, but it could be that there's a 20% increase for private school fees in general because of the VAT. Now, that might not necessarily be passed all the way through because private schools are able to offset some of that with the VAT they pay to their suppliers. But nonetheless, if you are paying for private school fees, if you are thinking about doing so, it's really important to plan for that in advance, particularly if it's going to cost you quite a bit more. So something we often help clients with is thinking about how much they're likely to need over the next 10 or 18 years. So modeling that, making sure they're investing so the money that they do set aside is working as hard for them as they can, which will hopefully lessen the burden somewhat. We've got capital gains tax increases on there next, and I'll talk about that in more detail shortly. It hasn't been announced, but it has been speculated on quite a lot and would be an easy source of raising tax, although there are questions on exactly how much that manages to raise. We have changes to non-dom tax treatment. So if you are a non-dom, if you live in the UK but you're not domiciled here, it's likely that you would need to pay a little bit more tax, although that doesn't affect that many people in the grand scheme of things. Would also be quite likely though. Then we have the reduction of pension tax relief when making contributions to pensions. Again, quite a speculative one, but at the moment, higher rate taxpayers can receive up to, additional rate taxpayers, can receive up to 45% of tax relief. There has been some talk of that reducing to a flat rate for everyone of maybe 30%, but again, that remains to be seen. Rent caps and controls, it's been talked about. If you're a buy-to-let owner and you're earning, say, retirement income from buy-to-let properties, rent caps would, of course, negatively affect your plan if it's quite a low cap and it's not allowed to increase by any more than inflation, say, or less than that. So again, hard to say on the specifics there, but certainly worth bearing in mind and having a conversation to think about how that affects your plans and whether it's worth moving to other asset classes if that is likely to affect you. Wealth tax is another one that's been talked about, and it's a big unknown really, because again, there are no details on specifically what that might look like. It's a notoriously difficult one for governments to actually raise money on, because it's generally considered quite bad to encourage people to sell illiquid assets to pay this tax on an ongoing basis. But there are lots of different ways that something similar could be introduced. So it could even be something like council tax bands being revalued. It's not a wealth tax per se, but it would tax wealth in another way if people with very expensive properties are made to pay more council tax. And then we have a couple of pension related points here as well, which I think are less likely, but are still possible. So we have the reduction of the tax-free cash you can take from your pension, and the reinstatement of a pension lifetime allowance. Now, that was explicitly ruled out before the election, but there's nothing to say it couldn't come in, or something similar couldn't come in the future. Next, I'm going to look at capital gains tax in a bit more detail, and talk about what that might mean for you, because we've had lots of questions on this. So currently, rates of capital gains tax are low relative to income tax, first of all, in the UK, but also relative to other countries more generally, if Labour are looking around for inspiration. So I've got the rates on the screen here. So it does depend on whether you're investing in shares or property. With shares or financial instruments, you pay 10% as a basic rate taxpayer, or 20% if higher or additional rate tax. With properties, so second properties, because you don't pay capital gains tax on your primary residence, you pay 18 or 24%. So, and you also have a tax-free amount of £3,000 per annum. In the future, if that was equalised of income tax rates, then you might not have a specific tax-free amount. You'd have your personal allowance that still applies, but then you might pay 20% as a basic rate taxpayer, or 40 to 45% if a higher rate taxpayer. So that could make quite a bit of difference. So what does that mean for you? What are your options now? Now, we wouldn't necessarily recommend clients sell their assets that they didn't want to otherwise, just to avoid a potential raise in tax. But of course, if the tax was to raise and you were thinking of doing that anyway, it would have been better to have sold those assets in advance. And we just give an example here. So if you have currently a £500,000 portfolio in a general account, it has a 30% gain on it currently, and then you would save £23,000 in tax by selling now at 20% capital gains tax, rather than waiting for it to increase. That being said, even though capital gains tax increasing wouldn't be beneficial, of course, for those with these taxable portfolios, nonetheless, it's still worth pointing out, we think, that it's still likely to be better to invest for the long term, even when rates increase in the future, rather than, say, sitting on cash where you pay income tax anyway on the interest, or just not investing at all, just leaving the money there. So not a particularly welcome policy for those with these assets to sell, but yeah, if you're looking at making a change anyway, it might be the time to expedite that process. And moving on to pensions, as I've touched on, immediate changes appear unlikely. It could be that something's announced at the autumn budget. But going through the points here, we have the lifetime allowance. So as I said, it's been ruled out, but if it was reinstated, it's actually quite likely, we think, that you would be able to apply for protection to protect yourself if your pension's above the lifetime allowance, or whatever it's instated at. So that's worth keeping an eye on and making sure you're attuned to that. The reason I say it's quite likely is because previous Labour governments, before the Conservatives got into power in 2010, they did allow clients to apply for protection back then. So of course it's a different government, but nonetheless there is some precedent for that. Tax relief's one that could come around a bit sooner, we think. So currently, as I said, you can receive relief up to 45%. That could drop to the same rate for everyone. It might be 20% to match basic rate taxpayers, or it might be slightly higher to incentivize basic rate taxpayers to pay in more. If this does change, of course, you'd have been better off as a higher rate taxpayer making a contribution now. So it's always a good idea to make pension contributions, really, assuming you don't need the money until retirement age. But particularly now, it might again be a reason to expedite your plans and see if you can move that forwards, just to protect yourself against it changing. And then finally, on tax-free cash, so the current lump sum allowance, as it's now known, the amount you can take tax-free from a pension, is capped at 25% of the pension to a maximum of £268,275. If that was reduced, if it was abolished, then again, clearly it would have been better to have taken it at the current rates before it became worse for you. Again, we wouldn't necessarily recommend clients do this purely to get ahead of the rules, because it is speculative. There may well be protection if things were to change, But if you are close to retiring and you have a use for this money, you're not going to just leave it in your estate where you might then have to pay inheritance tax on it. Then it might be a good idea to, again, get the ball rolling and get your plan in place rather than waiting for things to get worse for you. And we've had some other questions in general as well on what other things might change, particularly on business relief, which is when it's designed for business owners. You're allowed to pass on assets outside of inheritance tax. That could be looked at, particularly AIM shares, because they are eligible for this, even though it's not what the rules were originally designed for. Again, it's really speculative to say what might happen, but it would be an easy target, and some of those rules are quite generous. So again, often people have only invested in those investments purely for the tax benefit. So if that was the case and actually the risk profile is not quite right for you, then again, it might be worth reviewing and moving into something where it's less likely that the rules negatively affect you, like a general portfolio in larger cap stocks, which don't really exist just for that tax benefit. So moving on to how we help clients at Netwealth, particularly on financial planning. I've just shown here some of the key areas we help clients with. Sometimes it's asset allocation, choosing the right risk level, sometimes consolidating pensions. It can be retirement planning, looking at how much income you have, what you're likely to receive from the state pension, defined benefit pensions, looking at your shortfall, and then identifying the best way of meeting that. We also do cash flow modeling that looks often at different scenarios. So you might want to stress test spending more money, spending less money, retiring sooner, making gifts. That can all be factored in to make sure you're optimizing things appropriately. And then pension planning as well, of course, and making sure you're using allowances appropriately, which can be particularly complicated when you're a higher earner and affected by the tapered annual allowance. There is a fee for this relative to our regular service, which you can see on the screen here. So if you opt for ongoing advice at Netwealth, you'd pay a total all-in fee of between 1.4% and 0.95%, depending on how much you invest. That covers absolutely everything though, including VAT, as you can see from the options at the top here, the investment management, the advice, custody administration. And we do also offer one-off pieces of advice, which is charged at £200 per hour. And you can see there, if it's a typical retirement report, it's likely to be around 8 to 12 hours work and £1,600 to £2,400. Great, so I'll now move on to any other questions that have come in. We have had quite a few. One in particular I wanted to find, and apologies for running over. If anybody does need to shoot off now, then feel free to email advice@netwealth.com or indeed book a call in directly with us where we'd be very happy to speak to you. There was a question I wanted to address on crystallizing a SIP, which is something that comes up quite a lot. So somebody's asked, I have a large amount in a SIP that's not been crystallized. I'm considering whether to take my tax-free lump sum, but would like your thoughts on the pros and cons. So I did touch upon that briefly. The pro to that is you've guaranteed that you've taken your tax-free lump sum and you may well have somewhere to use it. You might reinvest some of it in ISAs. You might invest some between you and a spouse, maybe in general investment accounts. The downside, though, is you're bringing money into your estate. And if you're not currently at the level where you can take the maximum tax-free lump sum, then you've sort of forgone some by not allowing the pension to grow more. So that's one of the downsides. But if you are about to retire and you have a use for this money, and you're not going to just leave it all in a general account paying more tax than you need to, or it's not just going to sit in your estate, then it can be a good thing to do. But it's not always a simple answer that way. It depends on sort of what other assets you have and what your plans are. I have a question here, maybe for you, Jerry. Your thoughts on potential actions on ISA allowances? So could the ISA rules change?
Yeah, one of the words I've not mentioned is redistribution. And even though the Prime Minister and the Chancellor haven't talked explicitly about redistribution, there's a lot of people around Labour who keep talking about redistribution. And this is part and parcel of their mindset. And it's relevant in terms of this because I think it was the Resolution Foundation, which is a think tank heavily used by Labour. They were talking about how some of the tax reliefs are overused by wealthy people. And their argument a little while ago was about tax relief for ISAs. Maybe it's disproportionate in terms of who makes most use of it. So the argument therefore was to reduce the sort of relief given to ISAs. There's no indication yet from the Chancellor or the Prime Minister that they're going down that route, but it's important to be aware that, and it reinforces your point about planning ahead, Tom, actually, it's important to be aware that even though not everything is going to happen immediately, there are different sort of scenarios, different paths that things could take us down in the future.
Excellent. We had an interesting question here as well, which is hard for us to answer directly, but your thoughts would be welcome. So, why are there no restrictions on foreign investors buying residential properties in the UK?
Oh, sorry, if you're asking me that. Well, there have been changes in recent years about the tax treatment in terms of um, owning of properties, and some of it was linked to whether it was being bought through companies, etc. Um, but more generally, while there are tweaks, the general scheme of things is that the UK is a very open economy. And on the positive, which is linked to people in the UK, the mind from where they come from, is we tend not to be retrospective. We tend not to introduce new rules and make them apply from the past. So the UK is always seen as being very open, transparent, and has to be said because of the rule of law. That makes the UK very attractive. But why do we not uh, put more checks and balances in place? The argument is it might have unintended consequences about deterring people from investing here, etc. I think it is an important point to raise, given that we do have an acute shortage. And the question that's often being raised is whether properties are actually lived in or used as an investment vehicle.
Yeah, it's quite topical, that question, isn't it? I've seen in Barcelona, for example, in the Canary Islands, locals being upset with tourists in general, but of course, people buying up properties that the locals can't use. There seems to be a slightly less of a concern in the UK in general, I think, as you said, for the investment benefits. Got another question here for you that's just come in, Jerry. How long does the government wait, as the economic data lags, before they consider generating revenue through the means that we have talked about? So
Okay,
will they?
Inter-
Sorry, go ahead.
yeah, right. What we know from the election is that Labour has a landslide, so therefore, as has been made clear, this is the optimum time for the Prime Minister to execute policies that may otherwise be difficult. But he has such a big majority, people think he has lots of room for manoeuvre. Against that is the point that the Labour Party, even though they won a electoral landslide, their share of their vote was lower than in recent elections, and also the turnout since the 1918 election, I think it was the second lowest turnout after 2001. So the electorate could yet be sort of potentially very volatile, albeit the next election is 5 years away. So you've got a balance between let's be radical, but mind in that even though we've got a landslide, we might not have the ability to execute everything freely as we thought we might. So therefore, it comes back to the questions. You don't necessarily execute policies that you need to bring all your stakeholders with you, the general public, your MPs, and also very importantly, as Liz Truss found out 2 years ago, you need to bring the financial markets with you. In terms of these, it's about making sure that the fiscal plans appear credible, and Rachel Reeves is very focused on that, hence empowering the OBR. But the process at the moment, as I touched on, is back to front. So if growth disappoints, then we will start to see more revenues being sought. I think in the budget later this year, the higher growth rate this year gives a bit more fiscal space. Rachel Reeves, the Chancellor, is likely to say we need to have more spending. So I think there will be some tax increases on some of the areas we touched on this autumn, as early as this autumn. But in terms of things like wealth taxes, etc., you implicitly get that through a revaluation of council tax bands, but those sorts of plans might well come more to the fore in 18 months' time if and when the growth rate starts to disappoint.
Excellent. Thank you very much. And that actually covers the last question I have here as well, which is our best guess of when capital gains and income tax might be aligned. And I think, as you said, it could well be the autumn.
Yeah,
But
the things have already been sort of put out there, shall we say, in terms of capital gains, VAT on private schools obviously was in the King's speech, so you touched on other things like that. Importantly, from that graph I showed, if you're not raising national insurance, VAT rates, or income tax rates, they're the three big taxes you have. Now, income tax allowances are going up, the economy is improving, so more people will be paying higher tax through that fiscal drag. So you then need to start to be looking at other areas. And if you immediately go for filling spending gaps this autumn, then you do need to go for tax increases this autumn. But other things might well be later, not sooner.
Excellent. Thank you very much. Well, that's it from the questions. Thank you all very much for joining. As a reminder, the link is still available in the chat function if you'd like to book a call in directly with us to discuss your plans. Also, feel free if you have any more questions, particularly personal ones, to email them to advice@netwealth.com. Thank you very much all for joining and enjoy the rest of your day.
Thank you. Take care. Bye.
Bye.